We're going to continue our discussion of depreciation by just doing a brief overview of the comparison of these various depreciation methods. And when you're looking at companies' balance sheets and maybe comparing two similar companies, to be aware of their depreciation methods so that you know that when you're looking at asset value and depreciation expense, that if you're comparing between two companies, that they're using similar methods, because you can see here from the graph on the left that in terms of the depreciation expense, the double declining balance takes a much higher depreciation expense in the earlier years and then lower the least amount in the later years. Straight line is lower in the earlier years, but then becomes higher, and the sum of the digits kind of falls in between the two. And similarly, the book value, the double declining balance will show the lowest book value, and then on up to straight line, where you will generally see the higher book value until the final year, where everything all meets up at the salvage cost. And so one of the things that we also want to look at, in addition to depreciation, is how this item, this particular physical asset, contributes to our profits. What can we make if we're trying to decide whether or not to buy piece of equipment A or piece of equipment B? One of the things that we're going to look at is not only how long is it going to last us and how well it's going to perform, but what's going to be the return on this investment. And we're going to calculate the return based on the average book value of our assets in a given period. Now, obviously, our book value is going to be different depending on the depreciation method we use, and may thus potentially skew our rate of return results. So this is something that we need to be mindful of when we're calculating the rate of return on our assets. As I said it earlier, we can either depreciate based on groups or based on composite. And the group depreciation we would use if we were doing similar items. I think they give examples of if we had a bunch of laptops that we bought, and we don't necessarily need to buy them all at the same time to use the group method, although that certainly makes it much simpler, excuse me. But then we also have a composite depreciation method where we can depreciate assets that are related kind of in bulk, I guess I would say. So for the group depreciation, we're going to treat this entire asset class as though it were one for purposes of calculating our depreciation. And so we've got our cost of this group of assets, laptops, or in this case, we've got cars, and we're going to subtract the residual value of these cars and divide them by their useful life. And so that's going to give us $50,000, and it is going to equal 25% of the cost of the assets. Our journal entries that we're going to use for this analysis will be a debit to cars, obviously, to show, and we're not going to list each car as like the the Mazda or the Sentra or whatever. We'll just have cars, and then we've got the credit to cash, because apparently we're paying cash for these. Must be nice. Anyway, then we record our first year's depreciation and second. And in year 3, we decide we're going to get rid of 3 of these cars, or I guess at the end of year 2. And we're going to get rid of 3 of these cars for $8,000 each. So we'll receive cash of $24,000. We're going to debit the accumulated depreciation account, And then we're going to have the credit to the car's capital account for the 20,000 that was our initial book price times the 3 cars. And we've got year 3 now, and so we've got to make an adjustment to our depreciation based on the fact that we've reduced our asset group by this $60,000. So that's going to affect our depreciation expense going forward. And now we're going to dispose 5 of the cars at the end of the 3rd year for $6,000 apiece, and we do that just as we did with the other 2. And so I'm not going to go through each of these because it becomes a little repetitive, but just remember that we don't depreciate the group below the salvage value. Composite depreciation may be entirely different items, but because we use them together, like our office equipment, for example, we may depreciate those as a group. And so we will come up with a composite cost for these various assets and a residual value. And then we will determine an annual depreciation on sort of an aggregate. We will calculate each item to determine what its annual depreciation would be, but then come up with an aggregate total annual depreciation for the composite group. And so here we've got total annual depreciation of 7,000 by our total cost is a 14% depreciation. And I'm going to stop here and go on to the next video for the, well, we'll go through a couple more videos. So I think we've gone over this, but in terms of how we're going to disclose depreciable assets for the period, we're obviously going to disclose our depreciation expense on our income statement. We'll show the balances on the balance sheet and less any accumulated depreciation. And then we will also make sure that our footnotes show what methodology we use to calculate our depreciation so that users of our financial statements will note how we're doing this, so that if they want to make comparisons to similar companies, that they're able to do that. And now I'm going to go on to the next video.